Every trader has lived through this moment. You spot the setup, you do your analysis, you enter with confidence and place a stop at what feels like a safe level, just below support, just above resistance, maybe tucked under that obvious pivot. The trade begins, price moves around, and then it happens. The market drifts down, tags your stop by a few cents, and then instantly reverses. Within minutes, it's ripping in the exact direction you predicted. Except you're not in it. You're sitting on the sidelines, staring at the screen, wondering if someone's watching you through your webcam. It feels personal. It feels like the market is out to get you. But here's the truth. The market doesn't care about you. It doesn't know you exist. What you just experienced wasn't a conspiracy. It was liquidity. This is the PsyFi trading channel, where we uncover the hidden side of markets and the mind. Today, we're diving into one of the most frustrating experiences traders face: liquidity and stop-loss hunts. We'll break down the reality of how they actually work, share examples that show why it feels so personal, and give you practical ways to reframe your thinking so getting stopped out doesn't tilt you into bad decisions. Sit back, relax, hit subscribe so you don't miss what's next, and let's get started. Liquidity is the fuel that makes markets move. Without it, nothing happens. Buyers need sellers. Sellers need buyers. Big players, the hedge funds, institutions, market makers, can't just click a button and drop $1 billion order on the screen. If they did, the price would rocket against them before they even got filled. So what do? They look for liquidity. And the cleanest, easiest place to find it? Stop orders. Every time you place a stop, you're essentially broadcasting to the market. Here's where I'll give up. Here's where I'll sell if I'm long. Here's where I'll buy if I'm short. Now multiply that by thousands of traders thinking the same way. Stops naturally cluster at obvious levels. Right below support, right above resistance, just past yesterday's low, right beyond a breakout line. It's human nature. Everyone sees the same levels on the chart, so everyone hides their stops in the same zones. And when you get that clustering, you get a pocket of liquidity. That's where the big players want to transact. Picture it like this. You're at a concert and everyone's lined up at the same concession stand. If you wanted to sell water bottles, would you try to find people scattered randomly across the venue? Number? You'd go straight to the line. That's where the volume is. That's where you can unload as much inventory as you want. Liquidity pools are the concession stands of the market. Stops create the line. Institutions know it. Market makers know it. That's why price so often hunts those levels before making its real move. To a retail trader, it feels like an attack. To the market, it's just business. This is why those classic stop hunts happen around obvious levels. Support gets broken just long enough to trigger stops. Resistance gets pierced just far enough to trap shorts. Once that liquidity is grabbed, the larger players use it to position, and price moves away in the original direction. It's not about tricking you personally, it's about filling orders. Take a real-world example. Look at the Forex markets, where stop hunts are infamous. The daily highs and lows are magnets for liquidity. Price will often sweep just beyond a prior low, trigger a wave of stop losses from longs, and then rip higher. That quick dip wasn't about punishing individual traders. It was about clearing the board, grabbing liquidity, and giving bigger players the chance to get filled. Even in equities, you'll see it. A stock hovers near $50 support. Every retail trader in the world puts their stop at $49.90. Market makers know it. Funds know it. Price dips to $49.85, wipes out the stops, absorbs the liquidity, and then rockets back above $50. The retail traders cry foul. The institutions just did business. Here's the thing, it's easy to see this as manipulation, and in some ways, it is, but it's also the natural structure of the market. Without those liquidity grabs, large players couldn't enter or exit efficiently. The hunts aren't malicious, they're mechanical. Victor Niederhofer, who I mentioned in another video, once said that markets are designed to inflict the most pain on the most people as often as possible. And while that's a bit cynical, there's truth in it. The path of price is often the path of maximum liquidity, which usually means running through the levels where retail stops sit. But here's the critical reframe. If you keep getting stopped out right before price moves your way, it doesn't mean the market hates you. It means your stops are sitting in the same predictable places as everyone else's. You're swimming in the most obvious part of the pool. Daniel, a fictional trader we'll use as an example, lived this cycle for months. He was convinced the market was hunting him personally. Every time he went long, his stop would get clipped before the move higher. Every time he went short, he'd get wicked out before the drop. He thought someone was watching him. But what was really happening is that Daniel always placed his stops in the most obvious spot, right under the low, right above the high. He wasn't being hunted, he was just predictable. That predictability is why liquidity exists where it does. Retail traders flock to obvious levels. Institutions know it. Market makers know it. Price gravitates to those areas because that's where the liquidity is. If you can accept that reality, it changes how you view the market. Instead of feeling victimized, you start to understand the mechanics. You see the dip below support not as proof of a conspiracy, but as a liquidity grab. You see the false breakout not as manipulation, but as a sweep to clear stops. This doesn't mean you should abandon stops. Risk management is non-negotiable. Stops exist to protect your capital, not to guarantee you never get wicked out. But if you keep placing them in the most obvious zones, you need to accept that they're magnets for liquidity. The lesson isn't the market is unfair. The lesson is that your perception of unfair is actually just how the system works. And once you internalize that, the game changes. You stop asking, why does this always happen to me? And start asking, what does this tell me about how the market functions? That reframe is powerful because it takes you from victim mode to student mode, from anger to awareness. And awareness is what gives you a shot at surviving in a game most people never figure out. So the next time your stop gets clipped by a few cents before price rips your way, don't get stuck in conspiracy thinking. Ask yourself, was I just parked in the most obvious liquidity pool? And if so, how can I reframe my approach so I'm not swimming with the herd? That's the beginning of understanding liquidity. It's not personal, it's structural. And if you learn to see it that way, it can go from being your biggest frustration to one of your most important lessons. If section 1 was about understanding the why behind stop hunts, then this section is about the how. Because once you really see the mechanics, you stop taking it personally, and you start recognizing the patterns for what they are. Let's start simple. Imagine price hovering around a clean support level. You've got dozens, maybe hundreds of traders who went long on the bounce, each one placing their stop just under that level. Why? Because it feels safe. They think, if support breaks, I'm wrong. It's logical. Now picture a hedge fund or a market maker who wants to build a long position. They need size, but if they just start buying, they'll push the price higher before they can get filled. So instead, they push price lower, right into that cluster of stops. As those stops trigger, what happens? All those longs become sellers. That flood of sell orders creates liquidity, exactly what the bigger player needed to buy into without moving the market too much. Once they've filled enough, they let price float back up, and suddenly it looks like the support held after all. From the retail trader's perspective, it feels like betrayal. From the big player's perspective, it was just execution. This is the classic stop hunt. Run the level, trigger the stops, grab the liquidity, reverse. And it works in both directions. Above resistance, traders who short early pile their stops just above the line. Price pokes through, triggers the stops, liquidity floods in, and bigger sellers get their fills before the market drops. To the shorts, it looks like they were hunted. To the longs, it looks like a breakout fakeout. To the big player, it was simply the easiest way to transact size. You can see this play out across every market. Stocks, futures, forex, crypto. The mechanics don't change. Take forex as a perfect example. The London Open is notorious for stop hunts. Price will often run the prior session's high or low right after the bell. Why? Because that's where the liquidity sits. Everyone's clustered their stops around those levels. Big players sweep it, get their fills, then drive the real move. Crypto has its own infamous versions. Think about the countless wicks you see on Bitcoin's chart. Price spikes violently down or up, clears out stops, then immediately retraces. Retail traders call it manipulation. In reality, it's just the byproduct of thin liquidity and big orders looking for counterparties. Even major funds have been caught in moves that look exactly like retail stop hunts. During the 2010 flash crash, liquidity evaporated in equities. Algorithms swept levels, stops cascaded, and price collapsed before recovering within minutes. For traders caught in it, it was chaos. For the machines moving billions, it was just math. Let's ground this with a fictional retail story. Meet Daniel again. After months of frustration, he started to notice a pattern. Every time he put his stop directly below a key level, he'd get tagged. One day, he longed a stock at $20, with a stop at $19.90, right below support. Within minutes, price dipped to $19.88, clipped his stop, and then ripped to $21 without him. That night, Daniel reviewed his trades and realized the same thing had happened over and over. His stops weren't bad because he misread the setup. They were bad because he placed them where everyone else did. He wasn't being singled out. He was swimming in a crowd of liquidity, and the market did what it always does. It went fishing where the fish are. Here's another story from the institutional side. Back in 2006, Amaranth Advisors collapsed after its head energy trader, Brian Hunter, took massive leveraged bets on natural gas. His positions were so huge that other firms could literally see where his stops and margin calls would trigger. Rival players hunted that liquidity. They pushed price against him. His stops and risk limits triggered, and within weeks, his $9 billion fund was reduced to rubble. That's the institutional version of what happens to Daniel. When your stops are obvious and your size is visible, you become the liquidity, and the market has no mercy about taking it. Even legends aren't immune. Victor Niederhofer, once one of the most celebrated hedge fund managers in the world, was wiped out in 1997 when markets ran through his risk levels during the Asian financial crisis. His stops became fuel for bigger players. His brilliance didn't protect him from the mechanics of liquidity. The lesson is universal. It doesn't matter if you're trading $2,000 or $2 billion. If your stops are predictable and your risk is oversized, you're vulnerable to being part of the liquidity sweep. Now, it's important to clear something up. Stop hunts aren't always the result of some intentional evil plan. Sometimes they're just the natural byproduct of how orders stack up. Price moves where the orders are, and because traders tend to think alike, those orders cluster in predictable places. But intention or not, the effect is the same. Stops get run, liquidity gets filled, and the market often moves in the original direction afterward. This is why you'll hear traders say things like, "The market is designed to hurt the most people possible." It's not literally designed that way, but because stops cluster where psychology is predictable, price often moves in ways that maximize frustration for the majority. And here's the cruel twist. Sometimes stop hunts reinforce bad behavior. You place a stop, it gets clipped, price reverses, and you think, maybe I shouldn't use stops at all. That's the fastest way to blow up. Stops exist to protect you. They're not the enemy. The problem isn't having a stop. The problem is having it where everyone else does. Think about Sophie. After getting stopped out repeatedly at obvious levels, she got frustrated. One day she decided to go without a stop, determined not to get hunted. And for a little while, it felt like she'd solved the problem. Until the day the market didn't reverse. That single trade wiped out months of work because her refusal to use a stop left her exposed to unlimited risk. That's the balancing act every trader has to learn. Stops protect you, but they also expose you to liquidity sweeps if you're predictable. You can't abandon them, but you can reframe how you use them. The takeaway is this: stop hunts aren't a myth. They're not paranoia. They're real, but they're not personal. They're structural. Price runs levels because that's where liquidity sits. If you understand that, you stop seeing it as manipulation and start seeing it as part of the market's DNA. And once you see the DNA, you can start to work with it instead of fighting against it. Nothing stings in trading quite like getting stopped out right before the move you were waiting for. It feels personal. It feels like the market singled you out, as if someone was watching your account and decided to knock you out of the trade just to spite you. That feeling isn't random. It's psychological. When a stop hunt happens, it doesn't just hit your account. It hits your identity. You feel stupid for being the one who got clipped. You feel cheated, like the market broke some unspoken agreement. Worst of all, you feel powerless. And that's the emotion traders hate the most. The brain doesn't take powerlessness lightly. It responds with anger, with conspiracy thinking, with a desperate need to regain control. That's why stop hunts are so dangerous. They don't just cost you money, they trigger emotions that can lead to reckless decisions. Take Daniel again. After months of getting stopped out at obvious levels, he started to spiral. Every stop out felt like proof that the market was out to get him. He started watching YouTube videos about manipulation, digging through forums where traders swore the game was rigged. The more he convinced himself of this narrative, the worse his trading became. Because if the market is always against you, why bother following rules? Why bother using stops at all? This is the first trap: conspiracy thinking. It's easy to believe in when you're frustrated, but the reality is simpler and harsher. The market doesn't even know you exist. You're not special enough to be hunted. You just happen to be parking your orders in the same places as thousands of others, and when those orders cluster, price naturally sweeps through them. That's not a conspiracy, that's liquidity, but knowing that logically doesn't make the emotional sting go away, because stop hunts don't just cost you dollars, they bruise your ego. Ego is the second trap. When you call a direction correctly, you feel smart. It validates you. But when you get stopped out right before the move happens, it's almost worse than being wrong. You were right, but still lost. That contradiction is brutal. It makes you feel like you've been cheated out of what was yours, and that fuels anger. Sophie experienced this exact spiral. After a string of stop-outs, she started forcing trades. She widened stops to absurd levels just to avoid getting tagged. She doubled her size, telling herself she deserved to make it back. Each decision came from ego, not process, and each one dug her hole deeper. That's the third trap, revenge. Revenge trading after a stop hunt is almost inevitable if you don't recognize it. You feel personally wronged, so you try to strike back. But the market doesn't play that game. It doesn't respond to your emotions. It just keeps running its mechanics while you bleed. The combination of conspiracy, ego, and revenge is what makes stop hunts uniquely destructive. It's not just that you lost a small amount, it's that the loss feels unfair. And unfair losses are the ones that tilt traders the hardest. Think about casinos. Gamblers can stomach losses when they feel random. But if they think the dealer cheated, they lose their minds. The market works the same way. When you believe you were cheated, your psychology goes haywire. This is why reframing is so important. If you see stop hunts as evidence that the market is against you, you'll spiral into anger, conspiracy, and revenge. But if you see them as normal mechanics, as part of how liquidity works, you take the sting out of them. You shift from victim mode to student mode, and that shift saves accounts. Here's a practical reframe. Instead of asking, why does the market always stop me out? Ask, why did I choose that stop placement? Most of the time, the answer is that you pick the obvious spot. You put your stop where everyone else does. You weren't hunted personally. You were predictable. That's liberating, because predictability is something you can change. You can review your trades, analyze where you're placing stops, and adjust your approach. You can decide to risk smaller, give your setups more breathing room, or define your invalidation points more thoughtfully. The power shifts back to you. Another reframe. Remember that stop-outs aren't betrayals. They're part of the cost of doing business. Every professional trader accepts that being wrong, or appearing wrong temporarily, is baked into the job. George Soros, who built one of the greatest trading careers ever, famously said, "It's not whether you're right or wrong that matters, but how much money you make when you're right and how much you lose when you're wrong." That mindset takes the ego out of the equation. It doesn't matter if you were right about the direction. What matters is whether you managed your risk. If your stop gets clipped and then price runs your way, it doesn't mean you were cheated. It means you paid the cost of staying in the game. One more reframe. Zoom out. One trade doesn't matter. 10 trades don't matter. What matters is the series. If your system works over 100 trades, then an individual stop out is irrelevant. But when you treat each trade like a referendum on your intelligence, every stop feels like a personal insult. That's when psychology destroys you. The market rewards those who can think in probabilities, not certainties. Stop hunts are part of those probabilities. They're frustrating, yes, but they don't invalidate your edge. They're just bumps in the long series. Even Linda Rashka, a legendary day trader, has talked about this. She emphasized that part of being a consistent trader is accepting that false breaks and stop runs are simply part of the terrain. They're not signs of failure. They're signs of a living, breathing market. That's what traders like Lena eventually come to accept. At first, every stop felt like proof she was being hunted. But after journaling dozens of trades, she started to see the bigger picture. The stop-outs weren't personal. They were predictable mechanics. Once she reframed them that way, the anger disappeared. She stopped spiraling. She stopped revenge trading. She started trading her plan again. The psychological trap of stop hunts is thinking they're unfair. The reframe is realizing they're normal. When you get that, you take away their power over you. They stop tilting you into bad decisions. They stop feeding conspiracy thinking. They stop inflating your ego or crushing it. All that remains is execution. You see the market sweep a level, and instead of feeling cheated, you log it. You note where liquidity sat. You add it to your understanding of market structure, and you move on to the next trade. That's what professional survival looks like. The irony is that the same thing that feels like a personal attack is actually one of the best teachers. Stop hunts show you where the herd is hiding. They reveal the obvious levels. They teach you about liquidity without ever saying a word. If you can reframe them that way, they go from being the bane of your trading existence to being a powerful clue about how the market really works. And once you see them that way, you're no longer the hunted. You're the observer. You stop swimming with the herd. you start thinking differently. And in markets, thinking differently is what gives you an edge. So now that we've stripped away the myths and talked about the psychology, the real question becomes, what can you actually do about it? How do you keep yourself from getting stopped out in ways that feel like sabotage without falling into the trap of abandoning risk management altogether? The answer isn't to stop using stops. That's the quickest path to disaster. The answer is to reframe how you think about them and how you use them. First, you have to accept that stop outs are not failures. They're feedback. Every time your stop is hit, the market is giving you information. Maybe your entry was too early. Maybe your stop was too obvious. Maybe your setup wasn't valid to begin with. If you reframe the stop as data instead of defeat, it becomes a teacher instead of a punishment. That's exactly how Lena approached it. After getting stopped out over and over at obvious levels, she started logging every single one. She didn't just write down the price, she noted the setup, the exact reason for the stop, and what happened afterward. Over time, a pattern emerged. Most of her stop outs were at the most predictable places on the chart. Support lows, resistance highs, the levels every beginner sees. Once she saw that pattern, she didn't feel hunted anymore. She felt informed. That's the power of journaling. Without it, you're blind to your own habits. Your memory convinces you that you're always being targeted. But when you review dozens of trades in black and white, you can't deny the patterns. The frustration turns into clarity. Second, you can reframe how you place stops. Instead of parking them in the most obvious zone, ask yourself, where is my idea truly invalidated? Where is the point that proves me wrong, not just uncomfortable? For example, if you go long because you think a trend is intact, is your stop really just under the nearest pivot? Or is it under the structure that defines the trend itself? If you're shorting a breakout failure, is your stop just above the high? Or above the zone that would confirm the breakout is real? The difference between those two can mean everything. Stops placed at comfort levels get clipped easily. Stops placed at true invalidation levels often survive the noise. Now, this doesn't mean you can just move stops wider without thinking. Wider stops mean larger potential losses. The way to balance that is by adjusting position size. If you're giving your trade more room, you risk smaller size so the dollar loss stays consistent. This is the part most traders resist because it feels like they're missing out, but in reality, it's what keeps you alive. Sophie could have learned from this. Her problem wasn't just that she put her stops in obvious places, it was that she refused to size down when giving her trades more room. So when those stops hit, the losses crushed her. A smaller size with a more thoughtful stop would have protected her account and her psychology. Third, start thinking in probabilities, not outcomes. The reason stop hunts feel so brutal is because traders treat each trade like it's supposed to work. When it doesn't, they see it as failure. But professionals don't think that way. They know that even the best setups lose. What matters is whether the series of trades makes money over time. Think about it like a casino. The house doesn't care about one spin of the roulette wheel. It cares about thousands of spins. That's where the edge shows up. As a trader, you have to adopt the same mindset. One stop out means nothing. 10 stop outs mean nothing. What matters is the 100 trade sample, the 1,000 trade journey. This is where journaling and reviewing become even more important. If you can look at your stats and see that your edge is intact over a large sample, the sting of a single stop out fades. You don't tilt. You don't revenge trade. You just log it and move on. Fourth, protect yourself with daily and weekly risk limits. Stop hunts hurt worst when they lead to spirals. You get tagged once, you tilt, and suddenly you've given back a week's worth of gains in an afternoon. The way to prevent this is by setting a max daily loss, an amount where if you hit it, you shut it down. That rule isn't optional, it's survival. Marcus never had that rule. He'd get clipped on one oversized trade and then keep doubling down until his account was gone. If he had simply stopped after hitting his loss limit, his worst days would have been manageable. Instead, they became fatal. Risk limits aren't about avoiding pain. They're about avoiding catastrophe. They stop the small cuts from turning into amputations. Fifth, build the habit of zooming out. One of the reasons stop hunts feel so unfair is because traders zoom in too much. They stare at 1-minute charts, watching every tick as if it's life or death. But most liquidity sweeps are just noise in the bigger structure. If you zoom out to the hourly or daily, those wicks look insignificant. By keeping perspective, you train yourself to stop overreacting. You realize that a stop out isn't the end of your strategy. It's just a tiny event in a much larger process. That reframe takes the emotional power out of it. And finally, practice detachment. This sounds simple, but it's one of the hardest skills in trading. When you place a stop, you're making a deal with yourself. If price hits this level, I'm out. No questions asked. The moment you start debating with yourself, maybe I'll give it more room, maybe I'll wait a little longer, you've already lost. Detachment means respecting the deal you made. You take the stop, you log it, and you move on. This is why trading like a robot is such a powerful concept. Robots don't get offended when stops get hit. They don't spiral into revenge. They just execute. And while you'll never be a robot, you can train yourself to think more like one. The more you detach from the outcome of any single trade, the stronger your survival chances become. The practical side of surviving stop hunts isn't glamorous. It's not about finding a magic indicator that tells you where liquidity sits. It's about building habits that protect you when, not if, stops get run. Journal every trade. Place stops at true invalidation levels, not comfort zones. Size down when giving trades more room. Think in probabilities over hundreds of trades, not the next one. Use daily loss limits to stop spirals. Zoom out to maintain perspective. Detach from the outcome. Do that consistently, and stop hunts lose their power over you. They go from being the reason you blow up to being just another part of the landscape you navigate. Because at the end of the day, the question isn't whether stop hunts will happen. They will. The question is whether you'll let them tilt you into self-destruction, or whether you'll reframe them into just another cost of doing business. The traders who survive, the ones who actually build accounts over time, are the ones who choose the second path. By now you can see the pattern. Stop hunts aren't flukes. They aren't conspiracies. They're baked into how markets function. They're liquidity events. And the real difference between traders who survive and those who blow up is how they respond to them. The bigger picture here is that trading is never about avoiding pain completely. It's about managing it. Every business has costs. For a restaurant, it's rent and ingredients. For a retailer, it's inventory and logistics. For a trader, it's losses. Stops are your rent. Stop-outs are your cost of doing business. If you expect to trade without them, you're living in a fantasy. This is why reframing stop hunts matters so much. If you see them as a tax, you tilt. If you see them as costs, you shrug and move on. One view leads to spirals. The other leads to survival. Think about the legends who've lasted decades in this game. George Soros never avoided losses. He embraced them. He cut them fast and moved on, knowing that survival mattered more than being right. Linda Raschke didn't build her career by avoiding stop-outs. She built it by executing consistent setups and managing risk through the inevitable noise. Even the great Richard Dennis, who trained the famous turtle traders, emphasized that sticking to the plan, taking the stop without hesitation, was the cornerstone of their success. On the flip side, look at the blow-ups. Victor Niederhofer, Amaranth Advisors, Archegos Capital. All of them fell victim to the same hubris, believing they were too smart, too special, or too big to respect the mechanics of risk and liquidity, and the market punished them the same way it punishes retail traders every day. That's the humbling truth. The rules don't change based on your size. A $2,000 account and a $2 billion fund both get destroyed if they ignore stops, oversize, or treat liquidity like an enemy instead of a reality. So where does this leave you, the everyday trader who's sick of feeling hunted? It leaves you with a choice. You can keep seeing stop hunts as proof the game is rigged. You can spiral into anger, conspiracy, and revenge. You can treat each trade as life or death, let your ego run wild, and keep blowing up every few months. That path is always open, and most traders choose it. Or you can reframe, and you can accept that liquidity runs are part of the structure, not personal attacks. You can use journaling to see your own patterns. You can place stops where your idea is truly invalidated instead of where it's comfortable. You can risk small enough that the noise doesn't shake you. You can zoom out and remind yourself that no single trade matters. That path doesn't feel as exciting in the beginning. It doesn't give you dopamine hits. It feels boring, but it's the path that leads to consistency. It's the path that turns frustration into understanding and understanding into survival. And survival is everything. Because the truth is, you don't need to win every trade. You don't even need to avoid every stop hunt. You just need to stay in the game long enough for your edge to compound. That's what most traders never get. They keep looking for shortcuts, for hacks, for ways to eliminate pain. And in doing so, they sabotage themselves. The irony is that the very thing they're running from, the grind, the boring stops, the frustrating liquidity sweeps, is the thing that forges the discipline they need. The traders who embrace that reality, who stop treating it like betrayal and start treating it like part of the process, are the ones who eventually scale. Lena is the perfect example of this mindset. Early on, she got stopped out constantly. She felt hunted, cheated, just like everyone else. But instead of spiraling, she journaled, she studied, she reframed. Over time, she realized that those stopouts weren't attacks. They were clues. They showed her where liquidity sat, where the herd was, and how to think differently. Years later, her growth wasn't the result of avoiding stop hunts. It was the result of surviving them without losing her discipline. Her account compounded not because she was never wrong, but because she stopped letting being wrong destroy her. And that's the lesson every trader needs to internalize. Stop hunts will always exist. You can't avoid them. You can't outsmart them every time. But you can survive them. And survival is the only way growth happens. So the next time your stop gets tagged by a few cents before price rips your way, pause before you tilt. Ask yourself, am I seeing this as a personal attack, or am I seeing it as part of market structure? Am I treating this as failure or as feedback? Because that single choice, victim or student, ego or discipline, is what separates the traders who last from the ones who vanish. At the end of the day, liquidity isn't your enemy. It's the game board you're playing on. You can curse it, or you can learn from it. One keeps you frustrated forever. The other gives you a chance at freedom. And that's what this is really about. Trading isn't about dodging every stop hunt, it's about accepting them, managing them, and staying disciplined through them. Because the trader who survives long enough to let compounding work is the one who wins. So don't abandon stops. Don't spiral into conspiracy. Don't let ego convince you you're being hunted. See liquidity for what it is, the heartbeat of the market. Respect it, adapt to it, and let it guide you instead of tilting you. Do that, and you'll stop feeling like prey. You'll stop swimming with the herd. You'll start thinking differently. And in this game, thinking differently is the edge that keeps you alive. This is the PsyFi Trading Channel, where we explore the hidden side of markets and the mind. If this video hit home, subscribe so you don't miss what's next. Because the more you understand how the market really works, the less power it has to frustrate you. The less power it has to frustrate you, the more power you have to finally trade like a professional.